Global financial markets
From
have
the
just
heart of the
registered
nation's
a moment
capital,
that many
this
veteran
is the
analysts
evening news.
describe as an early warning
Breaking
signal.
news starts now.
Spot silver has officially crossed the $90 per ounce threshold for the first time in history, briefly touching approximately $91.53 per ounce within the same trading session, while gold has remained near its own historic peak at around $4,639 per ounce. This is not merely a commodity price spike. It is a systemic reaction, one in which global capital begins to move before policy statements even have time to appear. Reuters confirmed that this breakout occurred as investors broadly rebalanced portfolios in the face of economic and political risks that are becoming increasingly difficult to predict. What truly unsettled markets is not the fact that silver set a new record, but why it did so. Contrary to the popular media narrative that silver is rising because of demand from electric vehicles or solar energy, Reuters points out that the primary drivers of this rally are expectations of US Federal Reserve rate cuts, combined with geopolitical uncertainty and growing concerns over confidence in US assets and the independence of the Fed. This is the hallmark of defensive macro-capital investors seeking shelter from systemic volatility rather than a response driven by factories or industrial supply chains. Put bluntly, the interpretation that this rally is not rooted in industrial demand is reasonable when viewed through the short-term lens of financial flows. But it becomes misleading if one concludes that physical demand no longer matters. Reuters itself emphasizes that tight inventories and industrial investment demand remain the long-term foundation. However, sharp, near-vertical price moves within a single trading session are rarely triggered by silver being purchased for manufacturing. They are financial market reflexes to signals of systemic instability. Alongside developments in the United States, another geopolitical piece has been quietly heating up the physical market: China's tightening control over silver exports. In late December 2025, Reuters reported that Beijing released a list of 44 companies authorized to export silver for the 2026 to 2027 period, as China intensifies oversight of strategically important metals. This move immediately sparked debate because it transforms silver from a conventional industrial commodity into a lever of industrial policy and supply chain security. When a country that plays a pivotal role in global supply chains deliberately opens and closes the valve on exports, markets respond not only through price, but through distortions between paper markets and physical markets. Several major financial outlets in India recorded domestic silver prices climbing to record levels closely tracking the global surge. More strikingly, Business Standard reported that silver prices in China at times traded $5 to $10 per ounce above COMEX and LBMA levels, reflecting physical supply stress and widening regional price gaps. This has fueled a wave of independent analysis circulating within financial circles that places particular emphasis on the so-called Shanghai premium. It is important, however, to distinguish between verified data and scenario-driven extrapolation. Official data supports the existence of a meaningful premium, but claims that such price differentials could within a matter of tens of hours drain London's silver vaults are exaggerated attempts to manufacture urgency. The physical market is tight, but there is no evidence of an imminent collapse of Western storage systems. At the same time, a more technical factor, yet one with powerful short-term impact, is being closely watched by traders: margin mechanics in the derivatives market. Analysts have noted that CME could raise margin requirements to cool the market, and this concern is well-founded. The Associated Press previously reported that a CME margin increase in late December 2025 triggered a sharp one-session sell-off in gold and silver futures. The Economic Times likewise described a steep decline in silver prices directly linked to an increase in margin requirements for the March 2026 silver contract. Reuters, via mining.com, confirmed that CME has adjusted how precious metal margins are set, shifting toward percentage of notional value calculations in response to heightened volatility. In markets moving along an almost vertical trajectory margin, policy can matter more than headlines because it determines who is forced to sell. When prices rise rapidly and derivatives liquidity tightens, even a small change in margin requirements can trigger a technical air pocket, sending prices sharply lower despite an unchanged macro backdrop. This is why a powerful silver rally can coexist with violent short-term swings. Another factor feeding defensive sentiment is legal risks surrounding tariffs imposed under the U.S. International Emergency Economic Powers Act. Some analyses suggest potential refunds could reach into the hundreds of billions of dollars, but mainstream sources urge a more grounded framework. On January 8, 2026, Reuters reported that companies are preparing for tariff refund litigation on the order of roughly $150 billion if the US government loses at the Supreme Court. This estimate is based on approximately $133.5 billion in tariff collections from February through mid-December and is widely viewed as more realistic. SCOTUS blog has noted that the Supreme Court could limit remedies, for example, applying rulings prospectively rather than retroactively to reduce the scale of any repayments. Several major law firms have advised corporations to preserve refund claims, underscoring that this is a genuine legal risk rather than a conspiracy narrative. In other words, a fiscal shock scenario is plausible, but portrayals of hundreds of billions that must be repaid immediately lean more toward emotional amplification than a full reading of legal reality. When all these elements are assembled, no single cause dominates the picture. The current silver surge is the product of overlapping forces, expectations of Fed rate cuts, and geopolitical uncertainty driving safe haven flows. China's export controls tightening the physical market, price differentials between Asia and the West signaling stress, margin mechanics amplifying short-term volatility, and tariff refund litigation acting as a fiscal catalyst. And it is precisely where these forces intersect that silver begins to enter a phase in which price no longer reflects supply and demand alone, but deeper anxieties about trust power and the global financial order. The more consequential question then is, this is the current rally merely a temporary reaction by capital seeking safety, or an early signal of a deeper shift in the structure of global economic power where strategic metals become geopolitical instruments in their own right? Silver's break to new highs has done more than establish a new price level. It has exposed a reality the market has deliberately ignored. For years, the global pricing order for precious metals is beginning to fracture, and that fracture runs along an east-west axis. As silver prices accelerate at a pace rarely seen, the question is no longer how high is too high, but who truly controls price discovery, and by what means. For decades, the silver market has operated on a foundational assumption: prices set in London and New York represent the world. The West prices the rest of the world adjusts. During the days in which silver surged past its historical peak, that assumption began to wobble. Not because of any official declaration, but because physical flows started to change direction. Across Asia, particularly in China and India, silver has traded at levels materially higher than on Western exchanges at the same moments in time. This is no longer a routine technical spread. When premiums of several dollars per ounce persist, the market is forced to confront an uncomfortable truth: some buyers are willing to pay extra simply to ensure they receive real metal immediately. In financial markets, that is always a signal of a deeper anxiety beneath the numbers. That willingness to pay up is not driven by short-term speculation. It reflects a defensive mindset spreading across regions that have long treated precious metals as traditional reserve assets. As global supply chains are repeatedly disrupted by geopolitical tension, and as governments increasingly weaponize raw material exports as strategic tools, holding physical silver becomes less an investment choice and more a matter of security. On the other side of the divide, Western markets continue to function smoothly on the surface. Enormous volumes still flow through futures options and derivative products. On paper, everything appears to work perfectly. Yet this is precisely where the core contradiction emerges. The volume of silver traded on paper now dwarfs the amount of silver that actually exists in vaults, and the system remains stable only as long as too many participants do not demand physical delivery at the same time. In theory, widening east-west price differentials should trigger arbitrage that quickly restores balance. But silver is not a stock that can be transferred in milliseconds. It must be refined, transported, insured, stored and delivered. If readily deliverable silver in Western hubs is drawn down faster than it can be replenished, the premium ceases to be temporary. It becomes a signal of structural tightness deep within the market. It is at this point that the most sensitive question arises: which price is the real one? The price formed by millions of derivative contracts, or the price buyers are willing to pay to hold metal in their hands? When these two prices begin to diverge, the market is no longer debating direction. It is debating the legitimacy of the pricing system itself. Intermediary institutions are not passive observers. When prices rise too quickly and risk accumulates, a familiar reflex is triggered: margin requirements are raised, leverage is constrained, and weaker positions are forced out. In theory, this stabilizes the market. In practice, it resembles closing a pressure valve while the boiler continues to heat. Prices may be pushed lower in the short term, but the underlying pressure does not disappear, it is merely compressed. Such technical flushes often create the illusion that the frenzy has passed. But the history of metal markets suggests the opposite. If after each correction buyers return faster and with greater conviction, this is not a bubble deflating. It is a repricing process in a world that has become structurally riskier. What makes the situation more dangerous is the divergence in philosophy between the two halves of the world. The West prioritizes liquidity speed and financial hedging. Asia prioritizes ownership control and guaranteed access to physical assets. When these two frameworks collide amid escalating geopolitical uncertainty, precious metals become a silent battleground. On that battleground, silver is no longer merely a metal for industry or jewelry. It becomes an early indicator of shifting financial power, where large pools of capital are quietly positioning for scenarios the current system prefers not to name. When nations and institutions begin to question whether they will be able to access real assets in a crisis, precious metal markets are always among the first to react. But every shift carries a cost. As the physical market tightens, as regional premiums persist, and as technical measures serve only to delay adjustment, pressure ultimately migrates to a deeper layer of the system. That layer is where governments confront fiscal obligations stemming from past decisions, obligations that cannot be postponed through technical tweaks or reassuring rhetoric. And it is at that point of intersection where pressure in the metals market meets fiscal pressure at the state level that the most consequential question begins to form: does the current system still possess the flexibility to absorb the next shock? Or is silver merely the first signal in a chain reaction that few are prepared to confront? As silver flows begin to move beyond the logic of a conventional commodity market, the pressure does not stop at exchanges or vaults. It spreads into a deeper layer where figures on sovereign balance sheets are suddenly examined under the market's harshest light. At this level, silver is no longer a story about price. It becomes a catalyst that exposes the limits of fiscal power itself. For many years, major governments have operated on a familiar assumption: every shock can be absorbed with time, with new debt, or with the technical tools of central banks. In moments of crisis, the system stretches obligations, distributes costs, and postpones genuine adjustment. What makes the current phase different is the speed with which markets are reacting before those mechanisms even have a chance to engage. Fiscal liabilities arising from past decisions, whether rooted in trade policy emergency measures or legal disputes, were designed to be addressed over long horizons. They were expected to be dealt with later when conditions became more favourable. Markets, however, do not operate on political calendars. When risk shifts from a theoretical assumption to a plausible outcome, capital responds immediately without waiting for final rulings or detailed implementation plans. It is precisely at this point that precious metals assume a role no other financial instrument can replicate. Silver and gold require no promise of repayment, do not rely on creditworthiness, and cannot be printed to resolve short-term shortfalls. When markets begin to price the possibility that large fiscal obligations may have to be confronted in an environment of higher interest rates and fragile confidence, the natural reflex is to move part of capital away from policy-dependent risk zones. This sets off a dangerous feedback loop. As capital exits government bonds or policy-sensitive assets, borrowing costs rise. Higher costs force governments to choose between spending cuts, higher taxes, or additional borrowing under less favourable conditions. Each option carries economic and political consequences, and it is the narrowing of this policy space, rather than any single headline liability figure, that unsettles markets most. Within this context, silver's volatility becomes an early warning signal of a systemic issue. It suggests that markets are beginning to question the shock management capacity of traditional power centres. Not because collapse is imminent, but because safety margins are shrinking faster than expected. When those margins thin assets once considered peripheral suddenly move to the centre of defensive strategy. Notably, this reaction is not driven by retail crowds, but by capital flows that move quickly and at scale. Mass markets tend to recognise shifts only after prices have travelled far. At this stage, however, the signals are found in quieter places, persistent regional premiums, rising demand for physical delivery, and an unusually heightened sensitivity to legal and fiscal headlines. History has recorded these signals before major phases of financial reordering. As governments attempt to reassure that all obligations remain manageable, markets do not respond with arguments. They respond with actions. They buy assets that require no promises. They withdraw from structures built on assumptions of stability. In doing so, precious metals become a measure of actual trust, not declared confidence. This creates an uncomfortable paradox for policymakers. Intervene too aggressively to stabilise markets, and concerns arise about reliance on emergency measures. Intervene too weakly, and volatility erodes confidence. In both cases, room for manoeuvre is constrained by choices made many years earlier. For this reason, silver is not merely reflecting short-term anxiety, it is reflecting a shift in how markets assess power-related risk. When fiscal authority is constrained by debt monetary authority, by inflation and credibility, and political authority by legal precedent, markets gravitate toward anchors that sit outside any single system. History suggests that such moments rarely unfold in complete silence. They tend to begin with small, easily dismissed signals that gradually accumulate into a clear change in global capital behaviour. In its current role, silver is not the cause of instability, but the mirror reflecting it. The essence of this phase is not about predicting a specific price level or pinpointing the exact timing of a crisis. It lies in a change in market behaviour. Capital is beginning to act as though the old order no longer has sufficient capacity to absorb ever larger shocks. When confidence becomes the most fragile variable assets that sit beyond the direct reach of policy are the first to be repriced. Is silver's rally merely a defensive reaction to short-term uncertainty, or is the market quietly preparing for a scenario in which confidence in fiat currency is no longer strong enough to remain the central anchor when the next shock arrives? Share your perspective in the comments below.